Hi everyone. We are now going to look at the problems from chapter 4. And this is on page 220 of your book, problem 4-5. And it says, refer to the information presented in problem 4.4. Prepare a revised income statement for 2021, reflecting the additional facts. Use a multiple step format similar to what was in the book in illustration 4.4 of this chapter to prepare income from continuing operations, then add to this the discontinued operations portions of the income statement. Assume an income tax rate of 25% applies to all, and that 20 million shares of common stock were outstanding for the entire year. So just a different approach. We're going to take our sales revenue. Well, first of all, of course, we start with our heading, Alexian Systems income statement for the year ended December 31st, 2021. Sales revenue, 425 million, right? Sales revenue is 425. We then subtract cost of goods sold of 205. Now, they tell us cost of goods sold to number 3 was increased by 40 to correct an error in the calculation of 2020's ending inventory. The amount is material. Well, that's not correct. That should have been a prior period adjustment, and that 20 million or 40 million should have been corrected through retained earnings. It shouldn't have increased cost of goods sold. So we're going to take that out and then report 220 as our gross profit. Selling administrative says there's 154, but it tells us in part 1, selling and administrative expense includes 26 million in restructuring costs. Well, they should be reported separately on the income statement. So we'll take that portion out and put it on its own line. So our total operating expenses are 154. Subtract that from gross profit to get our operating income of 66. Now we are going to work on our other income, interest revenue, gain on sale of investments. Where do we get that from? Included in the other income is 120 million in income from a discontinued operation. This consists of 90 million in operating income and 30 million on the gain on selling the discontinued operation. The remaining 6 million is from a gain on sale of investment. So that's considered in the continuing operations area. That's 6 million. So we add those together to get our total other income of 10. Add that to operating income to get income from continuing operations before income taxes. Now we just don't subtract 39 from income tax. We know the income tax rate is 25%. So 25% of 76 gives us a 19 income tax expense. Subtract the income tax expense from your income from continuing operations before income taxes, and that will give you your income from continuing operations. Okay, so the majority of our information is occurring in that area, the continuing operations. And if this company didn't have a discontinued operations, that ultimately would have been net income. But this company does have a discontinued operation. So we have to report discontinued operations, income from operations of discontinued component, including the gain on the disposal. So we're reporting not only the income from operating it while it was in this discontinued category, but also the ultimate gain on selling it, 120. We then find out 25%, which would be our income, our tax on that income. So the actual income on discontinued operations is 90 because we have to pay tax on the 120. So we add the income from continuing operations to the income on discontinued operations to get net income for the year. So great practice on this multiple step income statement with a continuing and a discontinued operation. Further, we must calculate earnings per share for income from continuing operations, income from discontinued operations, and net income. It's required. So you just don't compute it using net income. You use it for those three amounts. So we will take the net income of, income from continuing operations of 57. There are no preferred dividends, and divide it by the, they told us how many shares of stock, and I forget now. 20 million shares of stock. So 57 divided by 20 gives us $2.85, because that's in millions there. $2.85 per share. The discontinued operations will take the 90 million divided by 20 million. 450 is the earnings per share on that. Net income then would be the 147 million divided by the 20 million, giving us $7.35 per share. Now imagine if we never reported earnings per share with those using those three key numbers on this income statement, and we just said earnings per share will be based on net income. This gives a false indication of the future of the company. This year they made $7.35 per share, but $4.50 of it came from an operation that's gone. It affected this year, but it will never affect this company again. So if we didn't report that, it would give the false impression that the company will continue to make $7.35 in earnings per share. And that's not correct. More like $2.85 per share. So that's why it's important to report earnings per share for those three key numbers when you have a discontinued operation. You don't have a discontinued operation, you are only going to have net income, because your income from continuing operations will be net income. So you'll only have to calculate one earnings per share on net income. So that was a great run through on the income statement. Our other problem is, I think it's 412, right? 411, make sure this one is 411. And that's on page 223. Now we're doing a statement of cash flow. Great review of statement of cash flow. Let's take a look. Sorry if I'm making you dizzy. So they present us with the income statement at the top for Santana Industries for 2021. And then they give us the balance sheet information for 2021 and 2020, which we would need to know in order to do our major calculations. It goes on the next page to tell us there were cash dividends declared and paid to the shareholders. They purchased equipment for $4,000 with cash. They sold some equipment, and there was depreciation of $1,600 in operating expenses. So they want us to prepare, as you can see, the statement of cash flow indirect method. So we start with the $4,800 in net income. Well, first of all, as always, we start with our heading. Santana Industries Statement of Cash Flows for the year ended December 31st, 2021. Now, our first major area we report cash inflows and outflows from is operating activities. Remember, in the indirect method, we're focused on converting net income from an accrual basis accounting to a cash basis of accounting. And that will give us how much cash we either brought in or paid out from doing our major operations. So net income for $4,800. Remember, the next step is to go to our income statement and determine, are there any items here that have nothing to do with cash? Depreciation. So we always add back depreciation expense. If we're trying to convert net income to cash, we've got to add back any expense that was taken that has nothing to do with cash. There's no other items on the income statement that would affect or need to change the any more adjustments. So now we go to the balance sheet, and we ignore the cash current asset because that's what we're trying to figure out why it changed. So we go to accounts receivable, and we only focus on the current assets, the change in them. So accounts receivable at the beginning of the year had a $2,200 balance. At the end of the year, it increased to $2,500. So I always tell students, when you're determining that change, well, what would I have to have done to accounts receivable to get it to $2,500? I would have had to debit it. We'll do the opposite to cash. So if accounts receivable is increasing on the debit side, cash is decreasing. And that's what you're trying to find out here. What's the effect on cash from that increase? It decreases. Inventory went from 3,000 up to 4,000, another asset increasing. So the effect on cash is decreasing. Prepaid rent went from 300 down to 150, so now it's decreasing. So we want to increase. It's the effect on cash is an increase of 150. So whatever happens to a current asset, the opposite effect happens on cash. So those are our current assets there. Equipment, we know, is a plant asset. We don't deal with that in this operating activities area. We deal with equipment in investing. Remember, long-term assets. So let's go to our current liabilities, and there's a few of them. Accounts payable went from an $1,100 balance up to a $1,400 balance. So whatever happens to a liability, the same effect is on cash. So if a liability increases by 300, cash increases by 300. The effect on cash is 300. Interest payable went from 0 to 100. So that's a positive impact as well. Deferred revenue went from 600 to 800. Again, the liability increases, the effect on cash is an increase. Income taxes payable went from 800 to 550, so it decreased. So the effect on cash is a decrease. And those are the only current liabilities. Remember, we're only reporting the effect on cash from the change in current or operating assets and liabilities. We're going to now determine and convert net income from accrual accounting to cash accounting. So we add the depreciation, subtract the 300 and the 1,000, add the 150, add the 300, add the 100 and 200, and subtract the 250. So the result is positive. So there's the net cash flows from operating activities is positive $5,600. The next thing we look at are cash flows from investing activities. And now we're looking at changes in long-term assets caused by cash. The only long-term asset this company has is equipment. Now, the equipment went from 12,000 to 14,500, but we don't report that change and walk away. No, we got to look at the cash impact from equipment. So now we go to page 224, and they come right on and tell us, equipment costing $4,000 was purchased with cash. So from an investing activities perspective, that has a negative impact on cash. You're paying cash. So we bought. So what I'd like to do here is I create a T account for equipment, and I start with the balance at the beginning of the year, 12,000. Okay. And then if we bought 4,000, my equipment account would have increased $4,000, right? Now, in the next part, it says equipment with a book value of $500. The original cost was $1,500. Let me see if this works out. Oh, okay. $1,500. I would have credited the equipment account for that $1,500 when we sold it, right? You credit it for the cost. So we have $16,000 in debits, $1,500 in credits. So at the end of the year, my balance should be $14,500. It is. So I always do that just to make sure I got all the transactions that affected equipment and cash. Now in part 3, they sold that equipment. The book value, cost minus accumulated depreciation, was $500, and they sold it for $500. So they didn't sell it for a gain or a loss, but they did receive $500 of cash from selling that equipment. So that has a positive impact on our cash flows from investing activity. Notice we don't net everything together or just take the difference in the equipment account. We've got to look at these things separately. So the overall impact from investing activities is a negative $3,500. buying some equipment, selling some. The final area of the statement of cash flow is cash flow from financing activity. So guys, think about what we just did. We've determined the impact on cash from our income statement, right? We used the 4,800. We've already determined the impact on cash from our current assets and our long-term asset, our current liabilities. The only accounts on our balance sheet we have not determined impact on cash for are our notes payable, common stock, and retained earnings. So let's see. It says in part, oh, they don't even tell us that. Excellent. The beginning of the year, there was no notes payable. At the end of the year, there's a $5,000 balance. So what does that tell me? We borrowed $5,000 in cash. So cash flow from financing activities, there's an increase due to issuance of a notes payable. We took a loan. Common stock is the same amount, so there was no change in it at all. So there's no effect on cash. Now, retained earnings, we have to think about that account. We need to find any cash effects on retained earnings. Well, retained earnings starts with a balance of $2,700. Now, remember what happens to retained earnings during the year. It increases for net income. So I'm going to increase 2,700 plus 4,800. And if nothing else happened with retained earnings, there should be a $7,500 balance in it, right? The beginning balance plus net income. However, there's a $6,500 balance in it. So the assumption is that $1,000 was a dividend. The $1,000 that decreased retained earnings was because the company paid a dividend. Oh, duh, they told us that in part 1, right? So cash dividends are $1,000. We decrease financing activities. Remember, in financing activities, we're reporting the changes to long-term liabilities and equity that are caused by cash and the impact on cash. So let's net those two together. The net cash flows from financing activities for the year are positive $4,000. So we have a positive $5,600 cash flow from operations, negative $3,500 cash flow from investing, and positive $4,000 from financing. Overall, then, our cash increased for the year $6,100. Those three numbers combined. It starts at $2,200, and that's right off the balance sheet for cash. So if we add the $6,100 to the $2,200, that should be the ending balance of cash on our balance sheet, and it is. And that's how we complete a statement of cash flow indirect method. Now, there's no information here about other non-cash investing and financing activities, but please make sure you take a read through that. You may see it in other problems. And if you have any kind of questions on this or our income statement, please post them to the discussion board.